essentially, if a company distributes anything to its members without payment in return, without full payment in return, then a tax liability will arise. That's really where we're coming from. But the legislation does categorize these, and Section B would be other distributions in respect of shares. That is, distributions out of the assets of the company. And the big test is that the cost must fall on the company. However, it will exclude repayment of capital on the shares. But just let me, before we get too involved in the targeted anti-avoidance rule, let me go over the business asset disposal relief rules. And what that says is that for the 24 months to cessation in the case of a company winding up, cessation of trade, and then a disposal of shares or securities has to take place within 3 years of that date to secure the relief. So for the 24 months to the cessation of trade, it had to be a trading company or a member of a trading group. It had to be the individual's personal company, and the individual had to be an officer or an employee for those 2 years. So before we do spend time on the taxation of dividends, let's just have a quick look at company loans being written off. There was a time when this was quite, I would say, fashionable. It's not the case anymore, because not just because of this case, but because the dividend tax rates have gone up hugely, and it's no longer beneficial. So you're unlikely to see this as any form of an arrangement, but you could fall into it. So I ought to let you know what's going on. A participator who has a loan written off is accessible to income tax under Section 415 of ITOIA, as if it's a distribution. And now, if that participator is also an employee, then Section 366 gives priority to the Section 415 charge.